I enjoy coming to work every day knowing that clients are depending on me to guide them through whatever financial needs they have.
Every client we have is different. And so it's really about finding out what's really the most important thing per client.
With financial planning, everything is interconnected. So a comprehensive plan means that you're taking care of income needs now, income needs in the intermediate term, and income needs long term. We'll do an asset cycle portfolio. We'll do a risk-alize test. We'll do a life insurance audit or a life insurance review.
And so when we build a deep relationship with our clients, then we can take a step back and then we can look at different options to help them specifically get to their goals. One of the things I feel our job is as advisors is to introduce strategies to clients that maybe they did not know that they were out there. But it's our our job to come out and say, have you ever thought about this?
And the planning it's not always about income, but a lot of it is also about the legacy. So the element of family is very important to us, and it's important to our clients.
Hello, my name is Steve Jablonski, and I'm the host of Financially Speaking with Jeff Bush. Great show today, and it's great timing because we have been in a volatile market, and today are some tips on investing in a volatile market. And with that said,
yeah, well, hello, Steve. Welcome to the show. Great to be here on PCTV and the PCTV network. It's hard to believe we've been doing this now for 10 years. We're celebrating our 10-year anniversary, and of course now we're doing them here in our office here in Pottstown, high atop the Security Trust building. When we first started, we used to do them in the old the old studio in Pottstown High School, so just a few blocks from here. But anyway, yeah, today is going to be a great show because we're going to talk to our viewers about investing in a volatile market, and that's really, I think, really a key to success in investing, because the volatility, if you look throughout history, there's always been volatility in the market. So the key is to be able to navigate through those. So I think it's going to be a good show.
and there's volatile markets, and then there's historic markets. Tell us a little bit about what happened last year.
Yeah, so historic. So we've actually rewritten a lot of history throughout our careers. You and I both got started in the business right around the same time back in the mid '90s. But last year was historic in that we saw a drop in the stock market, and then we saw a drop in the bond market, and we saw a drop in the commodities market as well. So if you had any of these asset allocation models, it was really hard to find a place to go because everything was down. And really a lot of that was caused by a significant drop in, or I should say, a significant increase in interest rates by the Fed. Yep.
And the halfway through last year, when you put the stock market and the bond market together, they were the worst ever. And when you got to the end of the year, not only were they worst ever, but the bond market was the worst we've ever seen, where you had 10-year treasuries down 15% and high-grade corporate down 15 plus. So it was
and again, I think that was because interest rate, the Fed kept rate. It seemed like every time they met, they'd increase the interest rates. And by the way, we're really not out of the woods yet on that as we sit here and record this really at the midpoint of 2023. We're really not out of the woods. And of course, a lot of this, Steve, is in an effort to control inflation. So there's that whole school of thought that if they raise interest rates, that it's it's going to have some control over inflation. But anyway, there's a lot of economic realities out there that have come to play here, and I think the important theme with all this is that even though, as you pointed out, last year was historic in terms of the way the markets all fell, at the same time we're recovering from that.
And you hear the terms bear and bull a lot. So what does that mean?
A bear market is when the index that it's tracking falls by 20% off of its high. Okay, so that's considered a bear market, and the stock market defined as however you want to define it, whether it's the Dow, whether it's the S&P 500, or whether it's NASDAQ, they all fell into bear territory last year. And conversely, a bull market is a 20% recovery or high off of the low.
The low point. Yep.
If that makes sense. So we're really we're in that territory now, recovering off of the lows that were, I guess, last November. So we're really in a recovery mode, or a bull market. Although it really doesn't really feel like a bull market
Because we've had the sideways market.
Yeah. So a sideways market is when the markets go up and then the markets go down, and it's very choppy. So if you look at a chart, you'll see the market's going up, the market's going down, market's going up, market's going down. And that's really the most difficult market to be in, because it's hard. There's no trend. There's no trend of where the market is going.
So when we get into some of the first thing when the market goes down, and we look at history where markets have been down 50%, and this last market was down 20%, but people tend to panic. What do we do?
Yeah, well, we tell them not to panic. I mean, in simple terms. No, I mean, really, we've been there before. The history has a tendency to repeat itself. And if we look back, we talked about our careers really spanning now almost 30 years. And, it's really been the most volatile 30 years probably in the market's history, because we've been through, we went through the tech bubble and 9/11, which we faced in, 2001, 2002. And then we recovered from that, and then we had the financial crisis in 2008 and the housing bubble or the housing crash. In 2008, then we recovered from that and went on a pretty nice run. And then in 2020, the pandemic hit. So those are all very historic things. And then, of course, last year we had a down year. So we've been here before, and we always recover from these events. Some of them are really kind of scary, but markets are very resilient. I always tell our clients that markets are very, very resilient, and they always have been. You can study markets going back much further than that, going all the way back to the Great Depression. And the markets recover. It's always time. Time is the great healer. And I always use the phrase, it's not timing the market, it's time in the market. So if you can have a long-term strategy with your investments, then you're going to prosper.
And how would you help somebody take the emotion out of the panic part?
Well, the There's a couple ways to do that, Steve, and that's a good question, because number one, you have to stick to your strategy. You have to have a plan. So that's the first thing that we do when we meet with our prospective clients is we put together a plan. It's a roadmap that we have a plan for, future success with your financial plan. And in that plan, there is provisions for markets to be volatile. And the best way to describe it is that you create different buckets of money. And we have a name for it. We call it the asset cycle portfolio. And with asset cycle portfolio, we have, assets are given job descriptions. And if the job description of a particular asset is long-term growth, then you're going to experience volatility potentially, and you just have to have a long view. You have to really look long in the market, and that's how you get through.
And in that, we also have we diversify within the different job descriptions.
Yeah. Diversification is really the key, because again, if you look at history and you look at different asset classes, sometimes different asset classes are going to outperform other asset classes. So, for example, you might have the large cap growth sector of the market prosper, while maybe the value sector, maybe the small to mid cap value sector, may not be doing as well. And then the opposite will be true. The value stocks will do well, but the growth stocks won't do well, right? And then you have the same thing with domestic versus international, stocks versus bonds. There's a whole array of asset classes that it's important to have the diversification so that you can take advantage of different sectors of the market as they're growing.
And also going back to the asset cycle, for short term, we position people, if they're taking distributions, versus the long term. The long term can.
That's where it comes down to. A lot of that comes down to risk, and I know you're going to talk about that in a little bit, Steve. But if you're looking really for short term, and when we say short term, a lot of times that means that you need to derive income from a certain asset. So if that is the case, then we want to take little to no risk with that asset. So that could take various shapes and forms. It could be cash. It could be some type of short-term annuity strategy. It could be a bond, something that has short-term growth and volatility, short-term volatility. And that can be used to derive income in the short term, and then that gives your longer term assets a chance to grow and prosper.
And in our Wellspring formula, we have part of it is what we can control and what can we help control. And one of the things is taking the time and finding out what someone's true risk is, and that's through Riskalyze. And so it's the fluctuation and how comfortable the clients are with the fluctuation, so we can have the discussion. If your portfolio goes down 5% or 20%, how comfortable are you going to be with that? So therefore, when the market does go down which it does, that our clients don't panic and the emotions out of it, because we had the right investments with the right risk tolerance.
Yeah. I think it's all about using those tools. In this case, the Riskalyze tool. That if you understand, and I think in a lot of cases we see that people aren't invested according to their risk tolerance. And I think the value that Riskalyze brings is we can quantify what that means. So with a Riskalyze test, you can say, oh, okay, well, I scored a 70 on my Riskalyze test. That means that I'm a aggressive investor. So your investment portfolio may not reflect that. Or maybe the opposite's true. Maybe you score like 25, which means you should have a conservative portfolio, and you don't. The portfolio, we look at maybe someone's 401k and we see that they're still invested in growth stocks, and maybe that was where they should have been maybe 15 or 20 years ago, but they haven't adjusted it for today's reality. So we see that a lot. But I think a lot of times it comes down to how we're positioning the portfolio consistent with how one is scoring on the Riskalyze test.
And we want to be proactive, not reactive. And right now in our practice, we're going through some minor changes as far as the what ifs. Like we help people, what if that the market goes choppy and up? What happens if it goes down? What happens if it goes sideways? So, we want to be proactive
yeah, I mean that's active money management. When you're being proactive to things that are happening in the marketplace, then you're in a position to make those changes. And we have certain strategies where we can do that, where they're on an investment platform where we can move some of these asset classes around so that we're able to react to the reality. And we learned a lot of lessons, I think, last year being 2022, in that we were able to see how certain investments were reacting to the extreme volatility that we were seeing in the market, a very choppy market, a very market that was defined by drops in various asset classes. So it was really an eye-opener.
And in our Wellspring formula, we have what we control, but then we also have the why side. And if you talk a little bit about that, and what type of, the goals for our clients.
Yeah. Well, I think with the Wellspring formula, it's all about what matters and what you can control.
Yes.
Okay, so there's a lot of things there's a diagram that and I don't know if we have that diagram with us today, but there's a diagram that shows what matters and what you can control, and right where those two circles intersect, that's where we live, where we operate in that, and that's really our Wellspring formula. And when we sit down with a client, and we think our approach is a little different than most, in that we're looking at form, right? Like what someone's form is. Form is family, occupation, recreation. Mm-hmm. And then those are the three things that matter to everybody: their family, their occupation, and their recreation. And then the M stands for money, right? So the money part of it is what sort of drives everything else. But the FOR is what is really what drives most people in the way they operate, and really the way they look at money.
Yeah. And then to go on top of that is the pillars that we had with the 7 pillars we use and how we came up with that. That was quite extensive.
Well, the 7 pillars was derived by us looking at our practice and looking at everything that we've done for our clients, and we counted that we did 113 things for our clients. Well, we couldn't have 113 pillars because that would be too much. That would be overwhelming. But we were able to boil it down to 7 things, and that's what we call the 7 pillars. And it's really pretty, some of it's pretty basic, but some of it is not basic. It's really a deeper dive into what we do in the area of financial planning, and then all of that together is our Wellspring formula.
And we talk about, like, the first pillar is wealth management.
Yeah, wealth
What's our-
management.
yep.
So wealth management is, we do wealth management. We think we do it pretty well, but so does everybody else. But it's everything. It's everything that comes along with that.
Then we have protection planning too, in the next one.
Protection planning is really, really critical, especially for our clients, because we're looking to growth isn't necessarily the primary objective, but it's protecting what we already have, protecting from a loss, just having protection from what you've already acquired.
And in that, there's a lot of people, they do a great job saving. They've done well. They've ridden the ups and downs. But when it comes to taking distributions, and we have the first half of the game and the second half of the game with the income planning.
Yeah, I think the income planning for us has been really the most important thing that we do, is trying to transform somebody's portfolio into how they're going to be, getting income when they ultimately retire. Because you're going to have fixed sources of income, whether it's Social Security or a pension. But the other key element is going to be how do we transform that 401k or that retirement account into a stream of income that's going to work for our client. So really, the income planning of it is really the cornerstone, and we've got models that are really set up to make that work and to make that happen.
And also charitable giving and legacy planning is also in the 7.
So the legacy, that's an important discussion also, because for almost everybody, they want to talk about how the assets are going to be passed down to the next generation. That's really the legacy. So then we start to have a discussion about the family, about the children, and the maybe the spouses that they have, grandchildren, and so on. Are there special needs? Are we looking at funding college education? There's really a lot of dynamics there. Do they trust their children in handling the money once they get it? So there's a lot of discussions that we have with our clients, and everybody's different. Everybody's situation is different. And then when we get into the charitable giving, there's ways that we can have the charities benefit from the estate, and how does that work, and how do we do that in the most tax efficient way?
And can't forget the value-added service with the 7 pillars.
So value-added.
We're doing a client event.
Yeah, so value-added services would be like different client events that we do, offering a second opinion, referring people to other areas where we don't have expertise. So, for example, maybe legal help, people that want to design a will or a trust. Maybe it be taxes. We don't prepare taxes in our practice, so we may be referring them out to CPAs. Or maybe other insurance that we don't do, like Medicare, for example. So there's really other areas of specialization that we refer out. So it's really that's value added. Those people are looking. Our clients are looking to us to provide that.
And when we look at investing in a volatile market, it's so important not to just focus on the performance. And we do comprehensive planning. We're independent. Tell us a little bit about the process we use and being independent.
Well, I think first and foremost is our responsibility as a fiduciary. The fiduciary role means that, and Steve, you and I as financial professionals this is part of our creed, is that, you know, we're acting in a fiduciary capacity, which means that we're acting in the best interest of our clients. So that becomes first and foremost, that we're not just looking for products and investments that are suitable, but we're looking for something that is really in our client's best interest. That's really important because we want to get to know our clients. We want to know what is driving them, what is important. You know, there's a whole element of the planning process that we feel is really, really important and helps us act in that fiduciary capacity. So I would say, you know, if you're looking for somebody to work with to do financial planning, or you're looking for advice, you want to make sure the person that you're working with is acting in a fiduciary role. Steve, one thing I want to mention too, while we're on that subject, is we have a public event coming up, and I don't know if were we going to talk about that at all today?
Yeah, that's actually
or
a great time.
Am I jumping the gun
no,
on
that's
that?
perfect timing.
Perfect timing, yeah. So we're going to be up at the Why I'm Missing Library in the coming weeks, and we'll put the dates up on the screen. But we have the Retirement Design Lab, or what we call the RDL.
Yep.
So the Retirement Design Lab, we're going to be in Wyomissing. You can see the dates up on the screen here, July 12th and July 19th. So if you're interested, come on out, and you know, you can call our office or you can email us, and we'll make sure we get tickets out to you.
And they're kind of neat because they're 2 nights, and one night focuses on a lot of the goals, and the other night focuses on a lot of the numbers and case design, case analysis.
Yeah, and it's a little different than what we had historically done in terms of public events, where they weren't necessarily workshops where, you know, here you're going to get a workbook, and it's going to be a much more interactive process, as opposed to us doing, you know, and we've been doing workshops, you know, for the last, you know, 20 plus years. But a lot of them have been like, we would look at like maybe money traps, or we would look at Social Security. And now we're really, you know, digging down into this Retirement Design Lab. And it's done in an educational setting. So we're going to be at the library, and it'll be 2 nights. So yeah, if you're interested in that, call our office and sign up for that.
And we want to keep everybody up to date on our 4 locations.
So yeah, so about a year ago we acquired 2 other offices. So now we have four offices. So we have the office here in Pottstown, 152 East High Street. Then we have an office and we'll put these addresses up on the board, or up on the screen rather. We have an office in Norristown. We have an office in Reading, and we have an office in Allentown. So that's 4 offices. So you and I travel a lot. We cover, and we have another advisor, Shannon. So between the 3 of us, we make our way through our 4 offices. But it allows us to really spread our wings and spread ourselves out geographically, and we can help people in all 4 of those offices. So with all that being said, we're going to put a wrap on today's show. I think it was good, Steve, that we took the time to talk about strategies for investing in a volatile market. If you're interested in any more information on anything that we talked about, please call us or email us. And we do offer a free complimentary consultation to anybody who signs up by watching our show. So with that being said, this is Financially Speaking.